It's December 2025. Silver has just done the impossible. It didn't just break the $60 barrier, it vaporized it, trading as high as $64.20. This isn't a 10% or 20% gain. We're talking about a near doubling in value in a single year. Everyone is screaming about the same things, the fifth consecutive year of a structural supply deficit. The solar panels devouring 20% of global supply. The AI data centers and EVs creating a demand monster we've never seen before. The vaults in London and Shanghai are scraping the bottom. The fundamentals, for the first time in decades, are not just strong, they are unassailable. So why does this feel so familiar? Why does the ghost of every past silver investor who got crushed seem to be whispering in our ear right now? Because we've seen this movie 3 times before, and every single time, a silent killer waited in the wings. In 1980, it wasn't just the Hunt brothers' scheme that collapsed, it was the leverage that destroyed them. In 2011, it wasn't just the end of QE, it was the speculative fever that evaporated. In 2021, it wasn't that Reddit was wrong, it was that hype cannot bend a $1.5 trillion market. This time, the script is different. The villain isn't a billionaire, a central bank, or a message board. The villain isn't out there. The silent killer of the 2025 silver rally is in the mirror. It's you. It's me. It's the collective psychology of every single person watching this price chart go parabolic. And if you don't understand how this killer works, you will become its next victim, even if you're 100% right about the fundamentals. Let me show you the trap that's being set right now. The data is so compelling, it's blinding us to the danger. According to the Silver Institute, the market is in its 5th straight year of deficit. The projected shortfall for 2025 alone is a staggering 117 million ounces. Mine production is essentially flat, inching up just 0.9% last year because most silver is a byproduct of other metals. You can't just turn on the tap. Industrial demand, which now makes up well over half of all consumption, hit a record 680.5 million ounces in 2024. Solar, EVs, AI servers, they are physical, consumptive sinks. That silver gets locked away in a panel for 30 years, in a car for 15. It's not coming back to the market. The investment case has never been clearer. As one analyst put it, silver has effectively become another AI play. This is the fortress of facts. This is the undeniable truth that the rally is built on, and it is from the towering walls of this fortress that the silent killer will push you. Here's the psychological pivot. You see the price at $64. You see the fundamentals. Your brain connects A to B. You think, this is sustainable? This is just the beginning. $75 is next, then $100. This is where the killer makes its first move. It convinces you that volatility is a thing of the past. That a market which just doubled in a year will now only move in one direction. Up, in a smooth, predictable line. Let me be brutally clear. That is a fantasy. Silver is nicknamed gold on steroids for a reason. Its market is smaller, and it has a dual personality. Half industrial commodity, half monetary asset. This makes it hypersensitive. It will react violently to every economic data point, every Fed whisper, every shift in manufacturing sentiment. Major financial institutions like ING warn that this volatility isn't going away. It's the defining feature of the landscape. They project an average price of $55 for 2026, which implies significant swings both above and below that level. Now, let's play out the killer's script. Imagine silver pulls back, not a crash, just a healthy, completely normal 15% correction from $64. That takes us back to $54.40. On a chart, that's a blip. In the mind of an investor who bought at $62, convinced of $100, that is an existential crisis. The comment sections will flood with, "It's over," and "The squeeze failed." The killer, your own psychology, will scream at you to cut your losses before it gets worse. It will tell you the fundamentals were a lie. This is the exact moment the silent killer feeds. It's called capitulation. It's the panic selling at the bottom that turns a temporary correction into a devastating loss. And it's fueled by 3 psychological poisons. 1. The disbelief of normalcy. After a parabolic move, we forget what a normal market even looks like. A 10% swing feels like a 50% crash. We mistake the inevitable ebb and flow of a bull market for its end. 2. The anchor of your entry price. Your brain becomes irrationally tied to the price you paid. Every move below that feels like a personal failure, clouding your judgment of the broader trend. 3. The amplification of noise. In a volatile market, every piece of news is magnified. A single analyst report suggesting solar demand in China might slow gets twisted into industrial demand collapses in the echo chamber of fear. This is the real risk that Goldman Sachs hinted at when they cautioned that silver is far more cyclical and a less reliable hedge than gold. It's not that the industrial story is wrong, it's that the narrative in your head cannot withstand the punishment of the charts. And here is the cruelest twist of all. This psychological volatility is the very thing that could trigger the one fundamental risk everyone thinks they're watching: demand destruction. Not from recession, but from success. Industrial users are not sentimental. At $60 plus silver, the calculus changes. Solar panel manufacturers, who are already achieving sharp reductions in silver loadings, will redouble their efforts to thrift and substitute. The race to find alternative conductive materials will get a blank check. High prices do two things. They encourage supply, which is slow in silver's case, and they destroy demand. The killer uses your own bullish conviction to make the metal so expensive it prices itself out of its own growth story. So, what is the antidote? How do you fortify your mind against the silent killer? First, decouple your emotions from the ticker. Before you invest a single dollar, write down your thesis. I believe in the multi-year structural deficit driven by green energy. My time horizon is 3 to 5 years. Tape it to your monitor. When the price gyrates, read your own words. You are investing in a physical shortage, not a daily price quote. Second, embrace volatility as a tool, not a threat. If you believe in the long-term thesis, a 15-20% correction is not a disaster. It is a potential opportunity to add to your position at a better price. The killer wants you to see a drop as a signal to flee. You must train yourself to see it as a test of your conviction. Third, practice brutal position sizing. The number one reason psychology breaks investors is overexposure. If a 20% drop in silver would keep you up at night or force you to sell, your position is too large. Size it so that you can withstand a 30-40% drawdown without panic. This isn't being pessimistic, it's being unbreakable. The silent killer isn't waiting in the shadows of the COMEX or the boardrooms of the Fed. It's in the dopamine rush of watching your portfolio soar and the cortisol flood when it dips. It's the story you tell yourself about how easy this should be. The wolf of physical shortage is real. The fundamentals are stronger than ever. But the 2025 rally will not be a straight line to $100. It will be a mountain climb with sheer cliffs and sudden avalanches. Many who are right about the destination will get lost on the path because they couldn't manage the weather inside their own heads. You can see the wolf. Just make sure that when you hear it howl in the night, you don't mistake the sound for your own fear.